Let's take a look now at investment. Please welcome Rebecca Wells. Rebecca is Vice President of Colliers Investment Services Group. Rebecca?
Thank you. You know, sometimes it doesn't pay to be accurate, but our predictions at last year's State of Real Estate proved to be right on. Well, almost. Here's what we predicted last year. Number one, investors have money to invest. That was true last year, and it's still true now. Hundreds of billions of dollars continue to sit on the sidelines, waiting for the right opportunity. Number two, debt underwriting will be more conservative. Absolutely, this was the big story in 2008. The lack of and cost of financing dramatically limited the number of sales completed. Number three, reliance on fundamentals. Investors have used increasingly conservative underwriting by valuing only tenants in place, using higher vacancy allowances, lower rent growth, and higher operating expenses. Number four, it almost goes without saying that 2008 marked the return to cap rates which are more reminiscent of 2003 to 2005. Once the credit markets were no longer fueling high prices, cap rates once again reflect the true value of the real estate and the income flow derived from that real estate. Number five, we predicted 2008 would mark the return to a more normal investment market. However, 2008 was a tough year for investment real estate. We witnessed the collapse of the financial sector and a complete freeze in the credit markets. The subsequent economic impact sent a shockwave through the commercial investment market, which was far from normal by year-end. 2008 began a little stronger than the finish of 2007, with several big deals closing early in the year. Across all the product types, $375 million of commercial properties sold during the first half of 2008. It looked like we might be able to escape a severe downturn in the market. However, by the third quarter, it was evident that the economy was in much worse shape than anticipated, and investors retreated to the sidelines once again. When we look back to the fall of 2008, we will probably view it as one of the bleakest periods we've seen in the last decade. Just $219 million of investment property was reported to have closed in the entire second half of 2008. The actual properties which sold are contained in detail in the annual report that you should have received when you came in today. So instead of going through those, this year I'm going to do something a little bit different and provide you with some information that you can't get anywhere else. Last month, Colliers Investment Services Group surveyed 120 of our clients nationwide to find out how the credit crisis has impacted the investment market and their outlook for 2009. Some of you here may have participated in this survey, and we thank you for your time and your thoughtful answers. The following is a summary of what our clients told us regarding the investment market going into 2009. And remember, these aren't our opinions. These are the opinions and predictions of other investors just like you. Regarding current conditions, investors perceive that we will continue to see values decline early in the year as weakening fundamentals are becoming increasingly apparent. Deflation and deleveraging will be key words in 2009. As a result, many investors don't feel they need to stretch for deals. The market is coming to them. The gap between the bid and ask pricing remains very wide. There are just no comps to judge values, and sellers are reluctant to sell at today's prices. We saw this occur in Indianapolis last year when several listings were pulled from the market when it became clear that investor interest and market pricing would not meet seller expectations. The search for distressed properties has begun. Investors are also focused on assets with debt coming due. The frozen credit markets are limiting the availability of debt, so assumable financing or seller financing will be important to completing transactions in 2009. Smaller deals will be more prevalent because they're more easily financed. but buyers will need to stay close to their relationship lenders in order to get their deals done. The bright spots: multifamily, medical office, and single-tenant retail. According to the investors in our survey, the key factors that will signal a return to the investment market are a prolonged period of stability in both the debt and equity markets, signaling confidence by consumers and businesses that the economy is on the mend. A substantial increase in the availability of capital and a willingness by lenders to lend and extend maturing debt. Stability in the job market. Investors have a heightened concern about the economy and unemployment going into 2009. Investors are also looking for a sense that the market has hit bottom, with realistic valuations along with the narrowing of the spread between the bid and the ask pricing. And finally, a pickup in sales volume, providing much-needed comparables, especially distressed asset sales, which will provide solid evidence that the market has leveled out. Investors believe the market will begin to show signs of stabilizing in 2009, but much of the year will be spent trying to determine the new value of real estate. Based on our survey, it's likely that transaction volumes will not pick up until the latter half of 2009, at the earliest, and quite possibly 2010. Our survey indicated only 22% of investors would be active buyers during the first half of the year. A much larger 78% said they would not be back in the market until the latter half of 2009. So, which investor types will lead us out of this? Our survey showed that the first buyers back to the market will be high net worth individuals, offshore investors, and private equity groups who are all scouring the market in search of attractively priced property. Active sellers will include lenders with REO assets, private investors looking to free up capital for other uses, institutions who are not prepared to actively manage problem real estate, and funds that will be forced to liquidate due to debt maturity. So where do we go from here? With the collapse of the investment market bubble, we can now see that 2005 to 2007 were not normal years, and neither was 2008. They were extraordinary years in many different ways. As we look forward to 2009, we will certainly face more challenges ahead, but with a different perspective than we've had for a long time. With more stringent underwriting and a more conservative approach towards debt and equity structuring, buyers and sellers and even lenders will be taking steps to accomplish one very important thing: an acceptance of a new reality. We enter 2009 with the knowledge that we're going back to the old days of buying and selling real estate based on the value of the bricks and mortar and the realistic cash flow that can be derived from it. Many of you in the audience benefited by selling assets while values were at the top. I hope just as many of you will find ways to benefit from where we are now by looking for and finding opportunities that didn't exist before. To do that, you will need to identify and focus on what you're really good at. Line up your cash, do your research, and be ready to move when the opportunities arise. Thank you for coming.
Certainly some interesting perspective from that survey. I think we all hope that Rebecca is right on target and that the market will stabilize this year and retain its competitiveness.